The CPI is a lie. Today I'm going to show you what inflation really is and how to properly track it. Hi everyone, I'm Cody Koch. Welcome to the channel where we talk about trading, investing, and business concepts. Okay, so this is the CPI numbers going all the way back to 1950. CPI, for those of you who are not familiar, is known as the Consumer Price Index. It is a measure of price inflation over time. Governments and corporations, everybody uses this generally as a rough measure of inflation. The problem with the CPI is it's completely inaccurate. And to prove that, I'm going to show this chart here. Now down here in the blue, we have the CPI numbers going back all the way to 1959. The reason we go back to 1959 is because that's when they started to track the M2 money supply. We used to have an M3 money supply, but the Federal Reserve stopped tracking that many years ago, and so instead we have the M2 money supply. The M2 money supply is the largest currently used measure of how many dollars are floating around in the economy. Now the reason I like to use the M2 money supply growth as a better measure of inflation is very simply for the fact that money supply growth is exactly and 100% what causes price inflation at the store. 100%. If the money supply goes up 10%, you are going to get prices to go up throughout the economy within about 2 years. They're going to go up 10%. It is as close to a perfect predictor as you can see. It takes time to disseminate through the economy. That's true. But whatever the money supply is doing, the prices at the store will follow suit within 2 years. Virtually always. Sure, there's games the Federal Reserve can play and the banking system can play to try to limit that, but generally speaking, whatever the money supply is going to do is what prices are going to do. And so for that reason, I want to show you that the M2 money supply is actually the best tracker of inflation throughout the economy. Okay, so just to put this out, now let me point this out. Let me show you this. So both started in 1959, in January of 1959 on this chart. That's when both were engaged in going through. And you can see here that the Consumer Price Index grew 927% over that time to today, and the M2 money supply grew 7,475% over that same time frame. Put that in perspective, that means according to CPI, what cost you $1 in 1959 now costs you $9.27. But according to the M2 money supply, what cost you $1 in 1959 now costs you $74.75. Now, in my experience, the M2 money supply is a much better predictor, and I will show you some examples of that in just a second. As you can see from the chart, the S&P 500 is significantly tracking the M2 money supply far more than it's tracking the Consumer Price Index. And that, like I said, is not a coincidence. Let me show you gold. Okay, so in this one, you're going to see gold versus the M2 money supply and Consumer Price Index. Gold is again in the light blue here. You can see gold at one point significantly outperformed the M2 money supply at some point in its history, going to 1979 and 1980. And then gold underperformed for a few decades and got quite a bit below the M2 money supply, and then gold outran it again. Gold's dropped off again. At the moment, it has not kept up with the M2 money supply. Gold is roughly where it was about 2 years ago, but as I said, it takes about 2 years for the money supply inflation to disseminate throughout the economy and raise prices by that amount. So I have a suspicion that at some point gold is going to catch up with the M2 money supply, but you'll see that it's significantly outperforming the Consumer Price Index, which is also notable because in theory, gold should track really closely the Consumer Price Index, but it does not. It has a tendency to outperform it over and over again. So this is the average single family home house price in the United States, according to the National Association of Realtors, compared to the money supply and Consumer Price Index. As you can see, going all the way, starting of course in 1968, as you probably have heard, that real estate beats inflation. You probably heard of this all over the place. And generally speaking, that's true if you're actually getting paid for renting out a piece of property. That's absolutely true. If you're getting paid to rent out a piece of property, getting paid from a tenant or something, it definitely beats inflation. However, as you can see, when they say it beats inflation, what they're referring to is it beats the Consumer Price Index, but it does not beat the growth in the M2 money supply. Why is that? Why do single family homes not keep up with the M2 money supply? The reason is that single family homes are sold not as just brand new. Many of these house sales that occur every month are actually from older homes. We're talking homes that are 10, 20, 30, 40, 50 years or older. And like any piece of equipment and anything humans built, older items tend to go down in value. They decline in value over time. Everybody knows that cars do this and trucks and so forth. Every piece of equipment in the world does this, computers and so forth. Buildings and houses do the exact same thing because they're built by human beings. They break and they fall apart over time. You will actually find when you adjust for real inflation, in this case, the money supply, you will find that most real estate does not actually keep up with real inflation very well, simply because it ages over time, it needs maintenance, it needs repairs. Unless you're renting it out to make profit from it, in which case that extra boost in rental does in fact, that extra cash flow you bring in from your rental income does in fact keep up with inflation very well. In fact, rental rates keep up with inflation very well also. And so I just want to point this out. But notice this, single family homes significantly outstrip consumer price index. Do not quite keep up with M2 money supply, but you'll notice as the M2 money supply started to rise, notice how fast the single family home prices started to rise. See that big spike right there? It had a significant effect and it really started to rock and roll. You'll see over here, you don't really see much of a blip in the M2 money supply, but you do see this bit of a temporary crash in the single family home prices back in 2008, 2009. That does of course happen sometimes. Okay, and I also wanted to show you what rental rates were. So this is what average rental prices are in the economy going back. Now I couldn't show you on that other chart. I didn't have access to that information on that chart, but you can still see it here. It shows here that it has increased at a rate of about 8.86% since 1980. That significantly outstrips consumer price data. And I'll show you the chart of this so you can see a very smooth trend going back to 1940 of historical median monthly rental rates. And so as you can see that there's been a steady, nice uptrend in this. They've been quite dramatic over many, many years. And so this is definitely being affected by the M2 money supply. All right, so this crazy chart is everything combined. Everything I just showed you minus the monthly rental rate I just showed you a moment ago. So what you can see here starting in 1968, this is when all the data was available. You can see that most assets, several of these assets have kept up with the M2 money supply, still here in orange, with the exception of the median house price in the United States. Unfortunately, that did not keep up, and it's for reasons I explained a moment ago. So this is very interesting to me, and it will show you what assets you probably want to pay attention to in the future that will assure you are most likely to keep up with inflation. Now again, housing is a big deal. Everybody talks about it. If you rent it out, it is very profitable. You can make a lot of money, and you will close the gap between the house's price and the money supply if you actually rent out the house. Okay, so if the M2 money supply is a much better predictor of inflation, so how exactly is the consumer price index so wrong? What makes it wrong? Well, they use a basket of 80,000 different consumer products. So everything from housing to electronics to clothing, food, etc. All kinds of stuff in this is in this basket. Now, some of these items you may not buy very often. It may be a rare purchase. Other items you buy regularly, like for example, all kinds of different food items at the grocery store. And what they do is they compile all of this data across the United States, or across the world for that matter, and they put that information into this big spreadsheet, and essentially they calculate all this and move it around. Now that's all fine and good. The problem is they use what's known as hedonic adjustments. Okay, so hedonic adjustment essentially means an adjustment for pleasantness or pleasure, so to speak. So what they do is they calculate the CPI, making the assumption that because things have improved, it can compensate for the increase in price. The issue with this is it's highly subjective when they do this. And so what they do is they effectively lower the real price of the item by some factor that they've decided to calculate, and then show it on the CPI as if the price actually didn't really go up that much. It's this very bizarre and unusual way to calculate inflation, and it doesn't work. It's quite frankly a very dishonest thing, and I will show you exactly what I mean by that. So this is an example of a hedonic adjustment. So as you can see, an entry-level computer in 2021, 1 gigabyte, 100 gigabyte hard drive, bargain price of $1,000. Cool. But an entry-level computer of 2022, you can see it's got 2 gigabytes of memory, 200 gigabytes of hard drive, and the bargain price of $1,000. So the price at the store is still $1,000 in both cases. But the CPI numbers will show it carried on the CPI as $500, which is even less than it was last year in 2021. They did this because they assumed that because this computer is twice as fast, the real inflation rate is half as much as it actually is. So weirdly enough, you can actually see they distorted, and quite frankly, it actually looked like a computer went down in price by 50% from 2021 and 2022. Now, this is an exaggeration. Of course, it's more of an exaggeration to kind of prove the point of this, but they do this through almost all of those 80,000 items on their basket, including apples, clothing, men and women's clothing, dresses. There is a debate amongst this hedonic adjustment that everything you see here is constantly being adjusted downward in some way, shape, or form. Other examples of this is they may take out certain types of beef, for example, and switch it for lower quality beef in the CPI, or they'll assume the beef is better quality, or they may assume some GMO'd corn is better quality or something. They make a lot of assumptions of the CPI and allows them to essentially figure out a way to make that number look lower than it really is. Okay, so to kind of prove my point a little bit here, I want to show what the CPI versus the M2 money supply have done since January of 2020. So you can see it over here on the corner, January 2020, they're zeroed out at the same level. And you can see the consumer price index rise, and you can see the M2 money supply a massive spike. This doesn't surprise anybody. A lot of people have heard of this. But what's interesting about this is the CPI numbers would say inflation's approximately 15% higher than it was in January of 2020 as of this recording. But the M2 money supply is showing a almost 41% increase. Now, as you kind of talk to people on the streets, you're going to find most people have found their food costs to rise by approximately 40%. Some cases more, some cases a little bit less. Housing prices until recently had risen quite a bit as well. There's been a lot of things throughout the economy that have risen approximately 40%. This is why they have had a massive increase in the money supply, and this is a much more accurate predictor of what the real inflation rate has been and will continue to be in the future. The CPI numbers, they are slowly creeping up, but they will, because of those hedonic adjustments, they will never get anywhere near as fast as the M2 money supply. So just for the future reference, just keep this in mind. The M2 money supply is a much better predictor of inflation simply because the M2 money supply is actually tracking the cause of inflation, which is an increase in the money supply. Very simple. This is not complicated stuff. A lot of people on TV and shows and everything like that will pretend that this is highly complicated, but the end result is that you increase the money supply dramatically, you're going to get a real price increase within 2 years, as I've stated. And because the consumer price index is so distorted and inaccurate, you're going to see that these numbers will never really keep up with it. So just kind of keep this in mind for the future. For those of you who like to invest or you like to track what real inflation is so you can ask for salary increases, all kinds of stuff, use the M2 money supply. So I would say is another tactic is depending on where you want to start it at, you can just come in here, you can bring up, this is TradingView, by the way. So this is totally free online. Anybody can get this. You don't even have to sign up. You can just come in here and look for the United States Consumer Price Index and then compare it to the M2 money supply of the Federal Reserve Bank, and you will get this chart right here. And you can start off with any time frame you want, and this will show you what the real inflation rate really was starting and ending based upon where you began this chart at. It's very simple. I use it all the time. It's super helpful. Is it perfect? I would not say it's perfect, but I would say it's definitely better than any other measure of inflation I've ever seen, especially better than the Consumer Price Index. Okay, that's what I've got today, everybody. If this video was helpful, please like and subscribe and leave a comment in the comment section, and thank you for watching.